Hi everybody, in this video I'm going to show you how to do a put credit spread. So first of all, whatever broker you're using, you have to have the correct level of options trading enabled. So first of all, you want to make sure that options trading is enabled and you have the correct level enabled. For example, on Robinhood, if you go to account and you go to settings and you go to options trading, you want to make sure that it's enabled and you want to make sure that you're at the correct level. So I'm at level 3. And what level 3 allows is buying calls and puts, selling covered calls, selling cash covered puts, exercising options, and most importantly, buying and selling spreads. Now, all these are enabled for me. I'm at level 3. You want to make sure that you're at the correct level where buying and selling spreads is enabled. Every broker is different, so you're going to have to look up what the requirements are to have options enabled and the correct level enabled to buy and sell spreads. Now that we've gone over that, and you make sure that you have everything enabled for you to buy and sell spreads, here's how you do a put credit spread. So take United Airlines, for example. Right now, United Airlines is at $38.60. And let's say that you're very confident that United Airlines is going to stay above a certain price by a certain expiration date. For example, let's say that right now it's at $38.60, right? But I'm going to think that next week it's going to stay above $32. Just an example. Go here to trade UAL options. So next week, September 25th, you pick an expiration date. Usually I don't like to pick an expiration date expiring the same week. I like to pick either next week or even several weeks out. Let's do October 2nd actually. So let's make a bet that on October 2nd, the expiration date, that United Airlines is going to stay above $32. So go down to put, because we're doing a put credit spread. First of all, we want to sell it the $32 put. Right? So Robinhood says here, short put. So we're selling the $32 put because we think United Airlines is going to stay above $32. Next, you want to buy a put at a lower strike price. So anywhere 31, 30, 29. I'm just going to pick 31. As you can see here, Robinhood instantly recognized that we're doing a put credit spread because we're selling it at $32, the $32 strike price put, and we're buying the $31 strike price put. When you sell a put and then you buy a put at the strike price lower than it, that's what a put credit spread is. And this basically means that you bet that by the expiration date, the price of United Airlines is going to stay above $32. You go to continue. You put in how many contracts you want to buy, open up, and then put in the limit price that you want to open it up at. And that's going to calculate the premium that you're going to get. So right now it's trading at a price range of 3 cents to 16 cents. So let's put in 10 cents, hope that fills. Review order. And then submit. So the minimum credit here is $10. That means on expiration, if it actually does stay above $32, we're going to get $10 for the credit. The collateral is the collateral that you're putting aside to make this trade, to open this put credit spread. You're putting aside $100. Let's do another example. let's say Amazon. So right now Amazon is at $3,086. $3,086. That's where it's at right now. Let's go here to trade Amazon options. Pick an expiration date. Let's pick November 20th. So our expiration date is November 20th. And we think that... Oh, what the heck? Oh, never mind. So we think on November 20th, it's going to stay above $3,000. Let's say that. So we pick the expiration date, November 20th. We're going to sell the put at a strike price of $3,000. All right. And we're going to buy a put at a lower strike price. $2,900. And as you can see here, Robinhood recognizes that we're doing a put credit spread because we're selling a put that we think Amazon is going to stay above, $3,000. We think Amazon is going to stay above the $3,000 strike price. So we're selling this, and then we're buying a put option at a lower strike price, $2,900. And that is a put credit spread. Continue. We're opening one contract. Limit price, put in a price to open it at, and hope that fills. 44.28 looks like the average. Review order. And as you can see here, the minimum credit is $4,428. So, if on November 20th, the expiration date, Amazon stays above the price of $3,000, we're going to get $4,428. The collateral, the money that we're setting aside, is $10,000. I don't have enough collateral because I already used up all my money. A useful website that I use when calculating put credit spreads is optionsprofitcalculator.com. This is optionsprofitcalculator.com, and as you can see, you can put in different graphs. You can see different graphs, different charts. So if we go here to spreads, credit spread, click on credit spread. Sometimes it takes a while, or I have to click it again. All right. So, for example, United Airlines, right? UAL. Get the price. Let's see, we pick 2nd of October. So October 2nd has the expiration date. Remember, we're doing a put credit spread. So let's say that we think it's going to stay above $31 on October 2nd. We're going to sell... Oh, whoops, it's out of order. So we're going to sell or write the $31 strike price put, and we're going to buy a put at a lower strike price. So $30 strike price put. As you can see here, this will give us a net credit of 6 cents. Press calculate. And there we go. We can see here on this graph the profit and loss chart. So right now it's at $38.60, I believe. And we can see here, depending on the date and the price, what our profit will be. So as you can see here, as time goes on, as long as UAL stays above $31, we're going to make a profit. So that's what you want to do when you're doing a put credit spread, is when you're very confident that the stock is going to stay above a certain price. I don't think this is investing. It's more like gambling, because you could pretty much lose all your money doing this. So it's very risky. However, it's a higher risk, higher potential reward, because it can pay off quite a lot, actually. So let's look at Tesla. Right now, it's at $444. If we think it's going to stay above a certain price, we can do a put credit spread on this. So let's go over to trade Tesla options. Pick an expiration date. So let's say by December. So on December 18th, we think Tesla is going to stay above $400. Sell a put at $400 strike price. And then buy a put at a strike price lower than $400, like $396. As you can see, Robinhood knows that we're doing a put credit spread. Continue. Contract, just one. Limit price, we'll put $215. Review order. And there we go. The minimum credit is $215. So, if we're right, and on December 18th, Tesla is above $400, we're going to get $251. Well, $215, sorry. And the collateral for this is $400. So in order to open this put credit spread, we have to set aside $400. As you can see here, you're setting aside $400, but the potential reward is $215. That's more than 50% return if you're right. But that's the thing. If you're wrong, you could lose like all of your money. So be careful when doing put credit spreads. I mainly do put credit spreads in my portfolio, and I've been making a lot of profits. As you can see, in the past month, I've already made 25% profit from just doing put credit spreads. So they can be really risky, but if you're super confident that a stock is going to stay above a certain price by a certain expiration date, then you can use a put credit spread to make some money off of that. All right. Good luck, guys, and have fun trading.